The statement of profit or loss. This video presents the main features of the statement of profit or loss. The statement of profit or loss brings together aggregated information about a company's financial performance within an accounting period, usually a 12-month period. Put simply, it brings together the company's accomplishments during the accounting period. This is the output of the company's activities, and the company's efforts or inputs used to achieve that output. The difference between output and related inputs is a measure of the company's performance during that period. If the monetary value of the output is larger than the monetary value of all efforts incurred, the company generates a profit for the accounting period. Conversely, if the money value of the efforts incurred is larger than the money value of the company's output, a loss occurs. In financial accounting terms, the output is set equal to income, usually the revenue or sales within the period, while the efforts incurred are referred to as expenses. Sales are usually recognized in the accounts when goods have been delivered or services have been performed to satisfy the customer's requirements. To find out whether the sale is profitable, one needs to match the sale with the expenses incurred in generating the sale. These expenses may relate to production, marketing, distribution, and administrative efforts performed by the company in order to obtain the sale. The nature of the expenses can be diverse and relate to raw materials and goods consumed, salaries and wages, depreciation, or the expenses related to using up the future economic benefits of the company's infrastructure, such as buildings, machines, or vehicles. External services, for example, the use of electricity, gas, water, transport, or consultancy services. Interest due on loan finance. Taxes. The expenses can be split into three sections: operating expenses, returns to loan providers, i.e. interest payments, and returns to government, i.e. taxes. According to these three categories of expenses, the format of a statement of profit or loss is split into the operating result, profit before tax, and net profit. Expenses and revenue which relate to the company's core business are compared in order to obtain the operating result. This bundle of information appears in the first section of the statement of profit or loss. The operating result is also called the operating profit or profit before interest and tax. Comparing the operating result of a company in time and with other companies, irrespective of the way the companies are financed, is one good indication of the company's financial health. Interest expense is a separate section within the statement of profit or loss. It covers the return to loan finance providers. It is not a return to shareholders. Its amount depends on the degree to which a company is financed by loans or debt. After deducting interest from operating profit, we obtain profit before tax. Taxes constitute the last section within the statement of profit or loss. Taxes in this section represent a return to government, society's share of the company's financial performance. The taxes listed here include only taxes on profits, for example corporation tax, not value-added tax, VAT, or other indirect taxes. The bottom line, obtained by subtracting taxes from profit before tax, represents the net profit for the period. This is what is left over to to provide a return to shareholders in the form of dividends and to finance future growth in the form of retained profits. It is the wealth generated by the company during the accounting period. The format of the statement of profit or loss that we have seen up to now is known as the expenses by nature approach and is very common in continental Europe. The operating expenses are classified according to their nature or the type of input they represent. However, in an Anglo-Saxon approach, the operating expenses are presented not by type of expense, but according to the functional area of the company in which the expense originates. This is also called the expenses by function approach. A minimum of 3 functional areas or types of activity can be distinguished: production, distribution, and administration. In the functional approach, revenue from sales is compared to the purchase and production-related expenses of the goods sold, to arrive at the gross margin. It must be noted that when a company reports a profit, this will be reflected in the bottom line of the statement of profit or loss, and it will also change the balance sheet. Remember too that owner's equity consists of share capital and retained profits. The profit or loss achieved within the period is added to the retained profits on the balance sheet if the profit is not distributed to the shareholders as a dividend. It is also important to remember that the increase of owner's equity on the balance sheet goes hand in hand with an increase in net assets, as reflected in the balance sheet equation.